Today's video is all about a crucial topic in trading: how to avoid the dreaded margin call. A margin call is a situation that can catch many traders off guard, but fear not. We're here to equip you with the knowledge and strategies to steer clear of it. Let's dive in and learn how to avoid margin calls. First, let's understand what a margin call is. In margin trading, when you use leverage to open a position, you're essentially borrowing money from your broker. A margin call occurs when the value of your account falls below a certain level, specified as the broker's maintenance margin. When this happens, your broker will ask you to deposit additional funds into your account to bring it back above the maintenance margin. Failure to do so can result in the broker closing your positions to recover the borrowed funds. Let's break down how a margin call works. Imagine you have a trading account with a $10,000 balance and you decide to use 10 times leverage to open a position worth $100,000. Your broker's maintenance margin requirement is 50%. That means you need to maintain at least $50,000 in your account to avoid a margin call. Calculating your margin call is essential to know where you stand in terms of risk. To calculate your margin call level, use this formula. Margin call level equals equity divided by used margin, multiplied by 100. Equity is your account balance plus or minus any profits or losses, and used margin is the amount reserved for your open positions. Next, and most importantly, we will direct our attention to the main topic: how to avoid a margin call. The first step to avoiding margin calls is to be honest with yourself about your risk tolerance. Everyone has a different comfort level when it comes to risk. Let's say you're a conservative trader with a low risk tolerance. Instead of using high leverage like 5 times or 10 times, you opt for 1.5 times leverage. While it might reduce your potential profits, it significantly lowers the risk of a margin call, allowing you to trade with more peace of mind. Implementing stop-loss orders is a critical aspect of risk management. Consider this example. You enter a trade on a stock at $100 per share and you set a stop-loss order at $90. If the stock's price drops to $90 or below, the stop-loss order triggers and your position is automatically closed. This prevents further losses and protects your account from falling into a negative balance and triggering a margin call. Diversification is a time-tested strategy to manage risk effectively. Avoid putting all your funds into one asset or a single trade. Let's say you have $5,000 in your trading account. Instead of investing all of it in a single stock, you diversify your portfolio by allocating $1,000 each to 5 different stocks. This way, if one stock performs poorly, gains in the other stocks can offset the losses, reducing the likelihood of a margin call. Stay informed about the markets and economic events that can influence your trades. Keep a close eye on your positions and monitor the market trends regularly. Be prepared to adjust your trading strategy if needed. This active monitoring helps you identify potential risks early on and prevents unfavorable situations like margin calls. To avoid margin calls, always maintain sufficient funds in your trading account. Don't exhaust your entire available margin. Keeping a buffer allows you to withstand market fluctuations without risking a margin call. Responsible account management is vital to protect your capital and continue trading with confidence. Consider this scenario. You have $2,500 in your trading account, and your broker requires a minimum margin of $1,000 to maintain your positions. Instead of using the entire $2,500 as margin, you set aside $1,500 as a buffer. This ensures you have sufficient funds to cover potential losses and avoid a margin call. Remember, avoiding margin calls is all about understanding risk, setting proper risk management strategies, and staying disciplined in your approach. By knowing your risk tolerance, using stop-loss orders, diversifying your portfolio, staying informed, and maintaining adequate account funds, you can trade with greater confidence and minimize the chances of encountering a margin call. Happy and safe trading! Thanks for watching. If you liked this video, be sure to hit that subscribe button and turn on notifications so you never miss a video.